Welcome back to another deep dive. Today, we are opening the file on a Canadian institution that is currently sitting at what I would call a fascinating, perhaps even slightly precarious, crossroads.
Mm.
We are talking about the Bank of Montreal.
BMO, the oldest bank in Canada.
The oldest bank in Canada, indeed, established 1817. But, we aren't here for a history lesson, at least not entirely.
Right.
We are here because we are standing in early 2026, looking at a stock that is trading at a significant premium, while the underlying fundamentals suggest something different.
Something a little more cautious.
Exactly. We've got a massive stack of research here. Morningstar equity reports, the latest earnings transcripts from fiscal 2025, and just a mountain of quantitative data. And the mission today is to answer one massive multi-billion-dollar question.
Which is?
Has BMO's aggressive, and I should say expensive, bet on the United States actually paid off?
Or, to put it even more bluntly, did they dilute the quality of a classic stable institution by chasing growth outside their comfort zone?
That is the central tension. Because right now, if you look at the ticker, the market is incredibly optimistic.
Incredibly.
As of, early December 2025, BMO stock is hovering around 177 Canadian dollars.
Yeah.
But the analysts, the people crunching the numbers at Morningstar, who look at the actual cash flows,
Yeah, they're telling a different story.
they peg the fair value at only 151 Canadian dollars.
That is a wide gap, a really wide gap. You're looking at a stock trading at roughly 1.7 cent times its estimated fair value.
Which in the world of banking is a lot.
In the world of boring, stable Canadian banking, that is a flashing light. It implies that the market is pricing in, a perfect execution of their strategy.
Right.
They are betting that the future is going to be rosy, that all the stars are going to align for them.
And our job today is to see if that bet makes any sense. We're going to unpack the concept of the economic moat, which is absolutely crucial here. We're going to look at the efficiency ratio battles, the revenue synergies that may or may not be happening, and of course, the looming threat of tariffs.
Right.
But before we get into the weeds of the P&L statement, let's zoom out. I want to start with the concept of defense. Section 1, the fortress.
The moat. It's probably the most important concept in long-term investing.
We throw this term around a lot. Economic moat. It's very Warren Buffett.
And it is.
But for the listener who maybe just checks their stock app once a month or is listening to this on their commute, let's ground this. What is the specific definition of a moat when we are talking about a bank?
So in its simplest form, an economic moat is a structural advantage. Think of a medieval castle.
Okay.
If you have a deep, water-filled ditch around your castle, it is very hard for attackers to storm the walls.
Right, it's a barrier.
It's a barrier. In business, the moat is what protects your profits from competitors. If you have a wide moat, you can charge decent prices, you can keep your customers, and you can maintain high returns on capital even when new competitors try to undercut you.
And in Canada, the banks don't just have a moat. They have what feels like a government-sanctioned force field.
It is effectively a protected garden. We call it an oligopoly. You have the big six banks, RBC, TD, Scotiabank, BMO, CIBC, and National Bank, and they control roughly 90% of the nation's banking deposits.
90%.
That level of concentration is, it's just unheard of in most other developed economies.
Yeah, if you look at the States.
Exactly. If you look at the United States, for comparison, you have thousands of banks, regional banks, community banks, credit unions, all fighting for scraps in a very fragmented market.
It's a street fight down there.
It's a total street fight. In Canada, it's more like a country club.
And the bouncer at the door of the country club is the government.
Precisely. The regulators, specifically OSFI and the federal government, make it incredibly difficult for foreign banks to enter and gain any real market share.
Right.
You don't see Chase or Citibank on every corner in Toronto or Vancouver. And crucially, the government effectively stops the big six from merging with each other to get even bigger.
Right. I remember reading about this in the history of the sector. You go back to 1998. BMO tried to merge with RBC.
And TD tried to merge with CIBC.
Then what happened?
And the government stepped in and said, no, absolutely not. They determined that it would be bad for consumers if the choices were reduced even further.
So that decision
effectively froze the market structure in amber. It guaranteed that these six players would dominate effectively forever.
So if you are one of the big six, you automatically get a wide moat rating, right? You're in the club, you have the protection, it seems automatic.
Usually, yes. That's a logical conclusion. The Royal Bank of Canada, RBC, has a wide moat rating.
Of course.
TD Bank has a wide moat rating. But here is the kicker for our story today, and this surprises a lot of people. BMO does not.
Wait, really?
Morningstar rates BMO as having a narrow moat.
It feels like a slight. It feels like being the only person at the party who didn't get the VIP wristband. Why is the fourth largest player in this exclusive government-protected club getting a lower rating than its peers?
It all comes down to the geography of their earnings. This is the critical distinction that investors really need to understand.
Okay.
A wide moat usually implies you can fend off competition and earn excess returns for 20 years or more.
20 years. That's a long time.
A narrow moat is more like 10 years. The reason BMO gets the narrow label is largely because they have aggressively, deliberately pushed into the United States.
So simply by leaving the safety of Canada, they lowered their own rating?
Statistically, yes, you could look at it that way. About 30 to 40% of BMO's earnings now come from south of the border.
That's a huge chunk.
It's a huge chunk. And in Canada, they are a protected incumbent. In the U.S., they are just another mid-sized regional bank fighting against giants like JP Morgan Chase, Bank of America, and hundreds of hungry local players.
Oh, they don't have the same pricing power.
Not at all. They don't have the same pricing power in Chicago that they do in Montreal. They don't have the same dominance. So by shifting their weight to the U.S., they have, in effect, diluted the overall defensibility of their earnings stream.
That is such a key insight. We tend to think growth is good. CEOs are always talking about expansion. But in this case, seeking that growth meant stepping out from behind the shield.
Precisely. You are trading security for opportunity, and the analysts at Morningstar are saying, because you traded that security, we can't be as confident in your ability to protect those profits 20 years from now.
But let's not paint too bleak a picture. I mean, a narrow moat is still a moat.
Oh, for sure. It's better than no moat.
Right.
Yeah.
So what are the actual bricks in BMO's defense? What keeps them profitable year after year?
Okay, so there are three main pillars that hold up the bank. First, cost advantages. They have a massive base of low-cost deposits. When you leave your money in a checking account earning, 0.01% interest or maybe nothing at all.
Which is most of us.
Which is most of us, right?
Yeah.
You are effectively giving the bank free raw material. They take that virtually free money and they lend it out at 5%, 6%, or 7% for mortgages and business loans.
That spread.
That spread, that net interest margin, is their bread and butter. And because they are so big, their cost of funds is just inherently lower than a smaller competitor.
It's good work if you can get it.
Yeah.
And the second pillar.
Operating efficiency. BMO is historically very disciplined. They know how to run a lean ship. They have the scale to invest in technology that lowers their cost per transaction, which, again, smaller banks just can't match.
Then a third is the one I feel personally. Switching costs.
Oh, absolutely. This is the hassle factor. Think about your own financial life.
Yeah.
You have your payroll direct deposit set up with your bank. You have your mortgage payments coming out automatically. You have all your utility bills linked, your credit card history. Maybe you have your kid's RESP or a retirement account there.
I would literally rather go to the dentist than switch banks. It's just a nightmare.
And the banks know that inertia is a massive asset for them. It allows them to cross-sell products and keep you in their ecosystem for decades.
Decades.
The average commercial client, for example, stays with BMO for over 15 years. That is an incredibly stable annuity stream. Once they have you, the cost to keep you is low and the revenue is recurring.
So the fortress is strong, but there is this breach in the wall called the United States, which we will definitely get to.
We will.
But first, let's look at the engine room. Section 2, the home front. We were talking about Canadian personal and commercial banking.
The cash cow.
This segment generates about 40% of their total revenue. It's the bedrock. But every bank in Canada has a vibe or a specific identity.
Yeah, they do.
RBC is the giant that is everywhere. TD is the retail open on Sundays. Green, comfortable chair bank.
Right.
CIBC is the mortgage bank. What is BMO's identity in Canada?
BMO is the commercial banker. That has been their DNA for decades. They are known as the bank for business.
Okay.
Specifically, they are the #2 bank in Canada for commercial loans under $100 million.
So we aren't talking about lending billions to Apple or Amazon. We are talking about the mid-market, the backbone of the economy.
Exactly. The manufacturers, the logistics companies, the car dealership networks, the big franchise owners, these are substantial businesses.
Right.
They need more than just a checking account. They need operating lines of credit. They need equipment financing to buy new machinery. They need payroll services. They need cross-border trade help.
And why is that such a good niche to be in?
Because it is sticky and it is lucrative.
Yeah.
These clients aren't as rate sensitive as a homeowner shopping for a mortgage who just goes to a comparison website.
Good point.
A business owner needs a relationship. They need a banker who understands their industry, who they can call when things go wrong. Once that relationship is established, BMO owns that space.
Looking at the data from late 2025, how is this engine performing? Is the engine sputtering or is it humming along?
It's resilient,
Yeah.
but there is some friction. If you look at the top line, adjusted earnings were up 5% year over year. Pre-provision, pre-tax earnings, which is a mouthful, I know.
That is.
But it basically means the pure operating profit before we account for bad loans. That grew by 7%.
So the core business is healthy.
The core business is healthy. They are lending money. They are collecting fees. The machine is working.
But you mentioned friction. Where's the friction coming from?
The friction is credit. Provisioning for credit losses, or PCLs, as you'll see them called, increased by 12% in the Canadian segment.
Okay, let's pause on PCLs. This is a term that puts people to sleep in accounting class, but it's actually maybe the most important number on the sheet right now.
It is the pulse of the economy. Think of it as an insurance policy against your own customers. Every quarter, the bank looks at its entire loan book, billions and billions of dollars of loans, and they have to make a statistical estimate. They say, based on the unemployment rate, based on interest rates, based on GDP growth, we think X amount of these loans won't be paid back.
And they set aside money for that.
So they take that money out of their profits immediately and put it in a jar.
Even if the loan hasn't actually gone bad yet.
Exactly. It's an anticipation of bad news. When that number goes up by 12%, it means the bank is seeing stress. It means their models are telling them that more Canadians are going to struggle to pay their bills in the coming months.
And we know why. It's the mortgage renewal cliff, isn't it?
That is the big one. Unlike in the U.S., where you can lock in a 30-year fixed rate and just forget about it, Canadians typically renew their mortgage rate every 5 years.
Yeah.
And we are currently moving through a massive renewal wave where people who locked in at 1.5% or 2% back in 2020 or 2021 are now renewing at 4.5% or 5%.
Ouch.
That payment shock is taking a lot of money out of consumers' pockets, and that stress is starting to show up in BMO's PCLs.
However, it's not all doom and gloom on the home front. There's one bright spot in Canada where BMO is punching way, way above its weight class.
ETFs.
The ETFs.
The exchange-traded fund machine. This is a fascinating subplot to the whole story. BMO is the number 4 bank by assets, but they are the number 2 provider of ETFs in Canada.
Number 2. Who are they battling with?
They are going toe-to-toe with BlackRock's iShares, which is the global giant.
How did they pull that off? Usually the biggest bank wins because they have the biggest distribution network. RBC has more branches. TD has more branches. How did BMO beat them to the punch?
They were first movers. Years and years ago, they saw the shift coming. They saw that investors were getting smarter and moving away from expensive, actively managed mutual funds toward cheap, passive index funds.
Right.
And while other banks were trying to protect their high-fee mutual fund businesses, essentially trying to hold back the tide, BMO embraced the disruption.
They cannibalized themselves.
They cannibalized themselves before someone else could. It's a classic innovator's dilemma move.
Kill your own cash cow before your competitor kills it for you.
And it paid off handsomely. They built a reputation for innovation and low costs. Now, Vanguard is entering the Canadian market aggressively, and that is squeezing fees across the board. It's a race to the bottom on price.
But BMO is positioned for that.
But BMO has the scale. In the ETF game, scale is everything. If you have billions in assets, you can run the fund for pennies and still make a profit. It's a volume game, and BMO has the volume.
So Canada is the steady, commercial-heavy engine with a nice side hustle in ETFs, but it's facing some credit headwinds.
A fair summary.
That brings us to the main event, the reason we are doing this deep dive. Section 3, the Great American Gamble.
This is where the narrative gets spicy. This is the show me story.
Since 2017, CEO Darrell White has been banging the drum. We must grow in the U.S. He looked at Canada and said, we are capped here. The growth is limited. We need a new frontier.
Right.
And the culmination of this strategy was the acquisition of Bank of the West in February 2023.
A massive deal, and frankly, a pretty controversial one at the time.
Let's talk about the price tag first. They paid 1.5 times tangible book value. For the listener who isn't an M&A banker, is that a lot? Is that like buying a used car for sticker price?
It's like buying a used car for sticker price plus a generous tip for the dealer. It was a full valuation.
Let's.
No, seriously. If you look at comparable deals around that time, like when U.S. Bancorp bought Union Bank or when PNC bought BBVA, USA BMO paid a premium, they paid top dollar because they really, really wanted this asset.
What was the logic? Why California? Why Bank of the West specifically?
Geography and demographics. BMO already had a solid foothold in the U.S., Midwest, Chicago, Wisconsin, Minnesota.
Right, from the Harris Bank deal.
Exactly, from their acquisition of Harris Bank decades ago. And that business was solid, but the Midwest is stable. It's low growth. It's not exactly a rocket ship.
It's the industrial heartland. Good, but not flashy.
Right. California is the opposite. It is the world's fifth largest economy all on its own. It's wealthy, it's dynamic, it has a massive population, and it has a totally different industrial, mixed tech, agriculture, entertainment. The idea was to connect the two, to create a super regional bank that spans from the Great Lakes all the way to the West Coast.
So we are now sitting here in early 2026. The deal closed almost 3 years ago. We can actually grade the homework now.
Yeah.
We don't have to guess. How is the execution going?
It's a very mixed bag. I think the best way to analyze it is to break it down into the good, the bad, and the ugly.
Okay, let's start with the good. Give me some good news. I need some good news.
The good is that BMO knows how to cut costs. They are excellent operators. When they bought Bank of the West, they promised investors they would find $670 million in expense synergies.
Expense synergies.
Right.
Which is just corporate speak for firing people and closing branches, right?
Unfortunately, yes, that's a big part of it. It means merging IT systems, closing duplicate headquarters, getting rid of layers of middle management, and consolidating vendor contracts. It's the ruthless operational side of banking.
And did they hit that number?
They crushed it. They actually delivered $800 million in savings, beating their own target.
Wow.
They found fat to cut that even they didn't know was there. And this proves that the management team is disciplined. They can execute a spreadsheet plan perfectly.
Okay, that's the easy part.
Yeah.
Cutting costs is within your control. You sign the severance checks. What's the bad?
The bad is revenue. This is the elusive revenue synergy. The pitch to investors wasn't just about cutting costs.
No.
It was, we are going to buy these Bank of the West customers, and then we are going to sell them all our great BMO products.
The cross-sell.
The classic cross-sell. We will sell them capital markets advice. We will sell them wealth management. We will sell them commercial treasury solutions. They targeted an extra $2 billion in pre-provision earnings from this.
Ambitious.
And crickets, or at least a significant delay. They have now pushed that target back to the end of fiscal 2026. The sources are using words like stalled.
Why is it so hard? Why can't they just sell a BMO credit card to a Bank of the West customer? Seems simple.
Because culture clashes and integration friction are real. It turns out it's much harder to cross-sell a California tech startup on a Chicago bank's services than they thought. Maybe the systems didn't talk to each other as well as they hoped. Maybe the sales teams were distracted by the merger itself, worrying about their own jobs. This is the classic M&A trap.
Right.
The spreadsheet assumes 1 + 1 = 3, but in reality, you often spend the first 3 years just trying to make sure 1 + 1 doesn't equal 1.5.
So costs are good, revenue is bad. That leaves the ugly.
Credit performance. Fiscal 2024 was a rough year for the U.S. segment. They saw outsized credit losses, specifically in their commercial loan book.
Okay, was this just the economy being bad? Or did they actually buy bad loans?
That is the multi-billion-dollar question, isn't it? It seems to be a mix of both.
Right.
The U.S. economy had some rough patches, particularly in commercial real estate. But BMO seemed to get hit harder than its peers.
Which raises a flag.
It raised a big fear among investors. Did BMO loosen its underwriting standards to grow fast? Did they lend to people they shouldn't have? Or, maybe worse, did they buy a loan book from Bank of the West that was lower quality than they realized during due diligence?
And that touches on the dilution of quality we mentioned right at the start. If you buy a narrower moat bank, you import their risks.
You do, right. But, and here's the pivot, looking at Q4 2025, the most recent data, the bleeding has stopped.
Okay.
In fact, adjusted earnings in the U.S. grew 100% year over year.
Whoa, wait. 100% growth? That sounds fantastic. Why aren't we popping champagne?
Loves. It sounds fantastic until you look at the denominator. The growth is 100% because the previous year, the comparison year, was terrible.
Ah.
They're comparing a decent quarter against an absolute disaster. It's called easy comps in the business. So they aren't necessarily booming, they just aren't crashing anymore.
So what is the number that matters? If I'm looking at the U.S. division, what is the one metric I should track to know if this whole gamble is working?
ROE, return on equity.
Right.
It measures how efficiently they are using the shareholders' capital in that specific division. For the U.S. segment, it is currently sitting at 8.1%.
Is 8.1% good?
For a Canadian bank, no. It's mediocre. The target the number management promised to investors is 12%.
12%.
And frankly, the cost of capital, the return investors demand for taking the risk, is probably around 9 or 10%. So at 8.1%, they are arguably destroying economic value.
Ouch.
They are running very hard just to stay in place.
So the entire stock price, that premium valuation of $177, is basically a bet that they can get from 8% to 12% in the next 12 months.
That is the show me story in a nutshell. If they hit 12%, the stock is a bargain. If they stay at 8%, the acquisition looks like a costly mistake and the stock has a long way to fall.
High stakes poker.
Oh.
Okay, let's pivot to the other parts of the empire. Section 4,
Right.
wealth management and capital markets. We often focus on the retail stuff because that's what we see on the street corner, but these divisions print money too.
And wealth management is the unsung hero here. Earnings were up 28% in Q4 2025. This is a very strong performance.
Why is wealth so attractive to a bank? What's the secret sauce there?
It goes right back to our moat concept. Switching costs in wealth management are incredibly high. Think about it. You have a financial advisor. They know your retirement goals. They know your kids' names. They know your anxiety about the market. Maybe you've been with them for 10 years.
It's a relationship.
It's a relationship. You don't fire that person just because another bank offers you a free toaster or slightly lower fees. It is emotional sticky tape.
And the data actually supports this.
Oh, it does. In Canada, the retention rate for their funds is around 85%.
That's amazing.
It is astoundingly high. It's
Right.
basically an annuity.
Yeah.
Every year, 85% of that money stays, paying fees. In the U.S., it's a bit lower, around 75%, because the market is more competitive and there are more independent advisors, but it's still very healthy compared to other industries.
Okay. Now let's talk about capital markets. This is the Wolf of Wall Street stuff. Investment banking, trading, underwriting IPOs. The report says earnings were up a staggering 97% in Q4 2025 compared to the prior year. That is an absurd number. Did they discover a gold mine?
Laughs.
Well, ironically, they are the best in the world at actual gold mines. BMO is the dominant player in the mining and materials sector for investment banking.
Oh.
If a mining company in Peru wants to merge with a company in Australia, they call BMO. That's their niche.
So the commodities boom helped.
Certainly,
Yeah.
but we need to put a giant flashing warning label on that 97% growth figure.
Okay.
Morningstar explicitly warns investors not to over-extrapolate this.
Over-extrapolate. That's analyst speak for don't get used to it.
Exactly. Capital markets are volatile. They are feast or famine.
Yeah.
If the stock market is booming and companies are doing deals, BMO makes an absolute fortune on fees.
Right.
If the market tanks or if volatility disappears, this revenue stream evaporates overnight. It is not like the mortgage business where you get a check every single month. In capital markets, you wake up every morning unemployed and have to find a new deal. So 97% is great for the bonus pool this year,
Very great for the bonus pool.
but don't build your retirement model on it happening again next year.
Exactly. Treat it as a nice bonus, not a core salary.
Okay, we've looked at the internal machinery, we've checked the engine, the transmission, and the tires. Now we need to look out the windshield at the road ahead. Section 5, the macro environment. Because banks don't operate in a vacuum. They are proxies for the entire economy. And in early 2026, the economy is, well, it's weird.
It is politically charged. We have to talk about the trade situation.
The tariffs.
Yes. In early 2025, the Trump administration announced 25% tariffs on a wide range of Canadian goods. Now, we aren't here to debate the politics or the fairness of it, but the economic reality is undeniable.
What was the market reaction?
Morningstar raised the uncertainty rating for all Canadian banks to medium solely because of this.
So just that one announcement changed the risk profile for the entire sector.
For the entire sector.
What is the chain reaction there? Trump tweets about tariffs, and BMO's stock wobbles. Walk us through the dominoes.
Okay, so tariffs mean Canadian exports, lumber, oil, auto parts become 25% more expensive in the U.S.
Right.
That means Americans buy less of them. That means Canadian companies sell less, their profits drop, they might lay off workers.
Unemployment goes up.
Unemployment in Canada goes up, unemployed people don't pay their mortgages, and they don't take out car loans. The bank takes losses. It's a direct line from trade policy to bank profits.
But BMO is in a unique position here, right? Because they are so heavy in the U.S.
They are naturally hedged. This is the great irony. The narrow mode expansion into the U.S. that we were just criticizing earlier, it actually protects them in this specific scenario. If the U.S. economy booms because of protectionist policies, if America First works for the American economy, BMO's U.S. segment, which is 40% of their business, benefits.
So while Canada suffers, their U.S. arm profits.
Exactly. A bank like CIBC, which is almost entirely Canadian, takes the full brunt of the pain. BMO has a foot in both camps. So if the U.S. outperforms Canada, BMO outperforms its peers. It's a diversification benefit that is finally showing up in a big way.
But there is another macro risk we need to discuss, and it's the one that keeps Canadian policymakers awake at night. Housing.
The eternal Canadian housing bubble.
Canadian consumer leverage is scary high. We all know this. Debt-to-income ratios are off the charts.
Way off.
But here is a silver lining for BMO specifically. Compared to its peers like CIBC or RBC, BMO has relatively less exposure to the Canadian housing market.
Correct. Their loan book is weighted more heavily toward those commercial loans we talked about. They have fewer uninsured mortgages on the books than a bank like CIBC, for example.
So if the housing market finally cracks, if prices drop 20% and people start walking away from their homes, BMO might get wet, but they won't drown.
CIBC is the one standing in the deep end of the pool without a life jacket in that scenario. BMO is sitting on the pool deck. They will get splashed, for sure, but they are structurally safer from a housing crash than some of their peers.
Okay, let's bring this all home to the valuation. Section 6. We have a price of $177. We have a fair value of $151.
Slightly overvalued is the official verdict from Morningstar.
It just feels like the market is ignoring the risks. Why? What are they seeing that the analysts aren't?
The market loves a turnaround story. Investors look at that 8.1% ROE in the U.S., and they don't see failure. They see opportunity. They think, hey, management is fixing this, expenses are down, the credit bleeding has stopped. If they can just get to 10% or 11%, earnings will pop and the stock will go to 200.
So they're pricing in the future.
They are paying up for the potential. They are paying for the future BMO, not the current BMO.
But if I'm an investor, I have options.
Yeah.
I don't have to buy a BMO. Let's do a quick comparison. If I want the fortress, the absolute safest bet, where do I go?
You buy Royal Bank, RWY, but
Yeah.
you pay for it. They are also trading at a huge premium, around 1.29 times fair value. It's the flight to safety trade. It's the stuff you buy for your grandmother.
Okay. If I want the American growth story, but maybe with a different flavor.
You look at TD. They have a massive retail network on the east coast of the U.S., from Maine all the way down to Florida.
But they've had issues.
But TD has had its own nightmares recently with money laundering investigations and regulatory caps on their U.S. growth. So they are in the penalty box a bit, which might make them cheaper, but it also makes them riskier.
And what if I'm a contrarian? What if I want something cheap because everyone hates it?
You look at Scotiabank,
Yeah.
BNS. While BMO went north-south to the U.S., Scotiabank went further south Latin America, Mexico, Peru, Chile, Colombia.
The Pacific Alliance strategy.
Which looked great on paper 10 years ago, but has really struggled with political instability and lower than expected growth. Their valuation is much lower, fair value around 78 CAD, so they are cheap, but they're cheap for a reason.
And CIBC.
CIBC is the all-in on Canada bet. If you think the Canadian housing market is invincible and immigration will keep powering growth, you buy CIBC. If you are worried about a housing crash, you run away from it.
So BMO sits right in the middle of all that. It's the commercial banking plus U.S. recovery play.
Exactly. It's for the investor who believes the U.S. expansion will eventually work, but wants the safety of the Canadian oligopoly as a backstop.
So what is the mission for 2026? Section 7. The sources mentioned balance sheet optimization. That sounds incredibly boring, but you told me earlier is where the money is.
It is the unsexy work of banking, but it's crucial. Balance sheet optimization means looking at every single loan on your books and asking, is this loan making us enough money to justify the risk?
Right.
If the answer is no, you get rid of it, you sell the loan to someone else, or you just let it expire and don't renew it.
They're pruning the garden.
Aggressively. They want to get their total bank ROE up to 15%. To do that, they need to lower the denominator, the risk-weighted assets. They are trying to become leaner and more profitable rather than just bigger.
And they have a target for the efficiency ratio as well, 58.8%.
Which, in plain English, implies spending roughly 59 cents to make a dollar. If they can hit that while stabilizing the U.S. credit losses, the stock price is probably justified. If they miss it, look out below.
So the final takeaway for the listener who's stuck with us through all this.
BMO is a dividend aristocrat. They pay out 40–50% of their earnings to shareholders. If you want income, they're reliable. They haven't missed a dividend in over a century.
Wow.
That is a track record you have to respect. But right now, you are paying a perfection premium. You are buying a narrow moat bank at a wide moat price.
The bull case.
The bull case is the U.S. economy avoids a major recession, the tariffs don't crush Canada, and the Bank of the West integration finally starts generating those revenue synergies we've been waiting 3 years for.
And the bear case.
The bear case is a trade war, triggers a Canadian recession, unemployment spikes, and the U.S. division remains a low-return drag on the company, stuck at 8% ROE forever.
It really does all come down to how you view diversification.
That's the thought I want to leave everyone with. We are taught that diversification is always good. Don't put all your eggs in one basket.
Right.
BMO looked at Canada and said, this basket is too small. So they bought a big, shiny basket in California.
But in doing so, they traded a position of absolute dominance at home for a position of fierce competition abroad. They traded a wide moat for a narrow moat.
So the question is bigger always better? Or is it just harder? BMO is finding out that it's definitely harder. Whether it's better remains to be seen in 2026.
We'll be watching that 12% ROE target. That is the scorecard. That's it for this deep dive into the Bank of Montreal. Go check your own portfolio. Do you own moats or do you own battlefields? Thanks for listening, and we'll catch you on the next one.
Goodbye.